Zomato listed in July 2021 and its listing day gains were over 50%. The stock closed 66% higher than its issue price on the listing day. Now, as of October 29, 2024, the stock has returned over 140% and is also among the top performers over the last year. Now, we analyzed Zomato about a month ago to see what's resulting in its spectacular performance. You can watch the video at the link mentioned in the description. Now, Swiggy, Zomato's main competitor, has come up with an IPO. Its issue opens on 6th November and closes on 8th November. The company is raising over 11,300 crores through this IPO. So, can Swiggy deliver returns like Zomato on listing and after it? In this video, we will try to find out. Hello and welcome to ET Money's YouTube channel. Today, we will analyze Swiggy's mega IPO to help you decide whether you should invest in it. This is the second biggest IPO of 2024 after Hyundai. Now, this video is divided into certain sections, which are on your screen. So without much delay, let's start. On your screen are the key details of the Swiggy IPO. The total issue size is 11,327 crores. As we saw, this makes it the second biggest IPO of 2024 by issue size after Hyundai. We had analyzed Hyundai's IPO as well, and you can access all our IPO analysis through our IPO playlist. The link is in the description. Now, of 11,327 crores, 4,499 crore is the fresh issue and 6,828 crore is the offer for sale or OFS. In a fresh issue, the money raised goes to the company, while in an OFS, it goes to the selling shareholders. The IPO opens on November 6, 2024 and closes on 8th November 2024. And the price band is 371 to 390 per share. The lot size is 38 shares, so the minimum investment at the upper price band for retail shareholders is 14,820. The pre-issue shareholding is over 212 crore shares and it will increase to about 224 crore shares after the IPO. There is also an employee quota of 7.5 lakh shares at a discount of 25 to the issue price. Alright, let's now take a look at the company's business and industry. Swiggy's main business requires no introduction, but it's the other businesses and how the company is positioning itself that we need to examine here. In its RHP, Swiggy describes itself as a new age, consumer-first technology company offering users an easy-to-use convenience platform accessible through a unified app. It has 5 business segments: food delivery, dining out and events under Dine Out and Stepping Out respectively, quick commerce under Instamart, supply chain and distribution covering B2B supplies, warehousing, logistics and distribution for wholesalers and retailers, new initiatives such as Swiggy Genie, its product pickup drop service, Swiggy Minis, which enables merchants to create their own storefronts, among others. So of the 5 business segments, 4 are B2C and the supply chain and distribution business is B2B in nature. To improve consumer stickiness and loyalty, Swiggy also has a membership called Swiggy One, which offers exclusive deals and discounts to its members. The company offers in-app payment solutions like its digital wallet Swiggy Money, Swiggy UPI, and Swiggy HDFC Bank credit card. Now, the financial and operating metrics of Swiggy's businesses are on your screen now. First comes the overall combined number of the Swiggy platform. The company's gross order value or GOV has gone up from over 20,000 crores in 2022 to over 35,000 crores in 2024. That's a growth of 32% per annum. Its gross revenue during this period has climbed from about 6,900 crores to over 12,300 crores, a 34% annual growth rate. But the company is loss making at the EBITDA level. The loss has contracted from over 3,200 crores to about 1,800 crores. The platform's average monthly transacting users have increased from about 1 crore to 1.4 crore. And the Swiggy One members have increased over 5 times during this period, from about 10 lakh to over 50 lakh. Next comes Swiggy's individual businesses. Their revenue share in FY24 is on your screen now. The food delivery business has the highest share of over 49%. Next comes the B2B business at 39%. The rest of the businesses comprise the remaining 12%. Now, Swiggy's food delivery business has been loss-making, but the losses have been fast reducing. They have come down from over 1400 crores to just 47 crores. This is a positive sign. In the supply chain and distribution or B2B business, the losses have contracted from about 302 crores to 187 crores. That's a good sign too. So, Swiggy's two largest businesses are on the turnaround path. However, the quick commerce or Instamart business and out-of-home consumption or dine-out business are losing even more money for the company than before. Instamart's losses have increased from 883 crores to 1309 crores. However, on a year-on basis, they have fallen. For the out-of-home consumption business, the losses have risen from about 137 crores to 174 crores over the year. Finally, the losses in the platform innovations business has fallen from 633 crores to 119 crores. Overall, 3 of the 5 businesses seem to be turning around, but 2 businesses seem to be burning cash for the company. Okay, let's also take a look at the industry prospects now. Now, Swiggy belongs to the hyper-local commerce industry. This is a new age industry whose growth is directly related to the economy's consumption growth. With its 140 crore population and shifting lifestyle trends, India is the consumption capital of the world. Other important factors that can aid hyper-local commerce growth include high GDP growth, a growing number of middle-class families, an increased number in nuclear households, rise in female workforce participation, shift to organized channels, greater internet penetration, and growth in gig economy. Now, the online food delivery market is expected to grow to 1.4 to 1.7 lakh crore by 2028, thus growing at a CAGR of 17 to 22% between 2023 and 2028. The online dining out market is expected to grow to 32,000 to 40,000 crores by 2028, thus growing at a staggering rate of 46 to 53% per annum. The quick commerce market is expected to grow to 2.32 to 4.2 lakh crores by 2028, thus growing at an ultra high growth rate of 60 to 80% per annum. So, overall, as far as the industry outlook is concerned, Swiggy has limited concerns and enjoys strong tailwinds. Okay, let's now move to the next section. But before that, an important update. We recently launched the stock discovery feature on the ET Money app. With just one tap, you can now get every detail about the stock and its underlying business, plus a lot more. So do check it out. Let's check some of Swiggy's key financials. The company's revenues have grown from over 6,000 crore to over 11,600 crore in 2 years. That's a CAGR of 38% per year. The company has been loss-making. However, the losses have fallen in the latest year. The company's cash flow from operations are negative too, though here again the loss is less as compared to the last 2 years. Now, due to the losses, the return on equity and operating margin are negative too. The company is almost debt-free as seen through its debt-to-equity ratio, and that's a good sign, especially for a loss-making company. Alright, let's now compare Swiggy's financials with its only listed competitor. Yes, you guessed it right, Zomato. Now, in absolute terms, Zomato is ahead of Swiggy in terms of the gross order value of their B2B businesses. In terms of market cap as well, Zomato is 2.5 times bigger than Swiggy. In terms of revenue, Zomato is again ahead of Swiggy in absolute terms as well as 2-year growth rate. In fact, Zomato's growth rate is almost twice that of Swiggy. Zomato is profitable both at operating and debt levels. Swiggy is not. However, Zomato became profitable only in FY24. Earlier, it was a loss-making business too. Zomato even delivered a positive cash flow from operations in FY24. Swiggy's CFO was negative. In terms of operating margin and ROE also, Zomato has a better profile, though loss-making operations in the past have turned the averages negative. Both Swiggy and Zomato are debt-free, so that's good for both. But overall, Zomato has a clear lead over Swiggy. Let's also compare the valuation of Swiggy and Zomato in terms of their market cap to sales ratio. The market cap to sales ratio is especially useful for valuing loss-making companies as both market cap and sales can't be negative. Here, Swiggy has a clear edge. Its valuations are less than half that of Zomato. Okay, let's move to the next section now. Business and financial analysis are not enough when it comes to IPO investing. There are almost many IPO related metrics that one should check. We discussed these metrics in detail in an earlier video on how to analyze IPOs along with some cool IPO hacks to increase your chances of success. You can watch that video later. I have mentioned the link in the description. Let's start with the first metric, fresh issue versus OFS. In a fresh issue, the money raised goes to the company, but in an OFS, it goes to the selling shareholders. So the company doesn't benefit from an OFS. As an IPO investor, you want that the major share of the IPO proceeds should be a fresh issue so that the company you are going to invest in is benefited. In Swiggy's IPO, as we saw, the fresh issue is about 4,500 crores and the OFS is over 6,800 crores. So the fresh issue is about 40% and the OFS share is about 60%. This implies that the majority of IPO proceeds are not going to the company. Now this may appear to be negative, but let's also take a look at who's selling the shares in the OFS portion. There is a long list of corporate and individual shareholders who are offloading their shares through the OFS. Interestingly, Swiggy doesn't have an identifiable promoter, but it does have some of the marquee names in its investor list. These include Process, which holds a 31% stake in the company through its affiliate MIH India Food Holdings, ACell, Tencent, SoftBank, etc. Now, it's rather natural for such private equity and venture capital companies to seek a route to book their gains or cut their losses. Swiggy's OFS is likely meant to serve that purpose. But notably, Swiggy's founders Lakshmi Nandan Reddy and Sri Harsha Majetti are also taking part in the stake sale. Given their low stake in the company, that may be concerning. The next metric is use of the fresh issue proceeds. The company plans to use the proceeds from the fresh issue for investment in its material subsidiary Scootsie and repayment or prepayment of its borrowings. A material subsidiary is one that contributes significantly to its parent company's business. Scootsie is the authorized distributor of various leading brands in India for wholesalers and retailers. It plays an important role in Swiggy's B2B supply chain and distribution business and in the quick commerce business. Swiggy also plans to use the proceeds for investment in technology and cloud infra, marketing, inorganic growth, and general corporate purposes. Overall, the use of the fresh issue proceeds is going to be for the company's growth, so that appears to be fine. The next metric is acquisition of shares by the selling shareholders during 1 year preceding the RHP. Most selling shareholders have acquired shares in the company in the last 1 year. Except for barren emerging markets and linked shareholders trust, the acquisition price for selling shareholders is way below the IPO price band of 371 to 390. Now this may mean a bonanza for them, but an inflated price for IPO investors, not a great thing. The next metric is outstanding litigation against the company. There are 4 criminal, 24 tax related and 4 regulatory proceedings going on against the company. The total amount involved is 361 crores. Against the company's subsidiaries, the litigation amount is 36 crores. So on in all, that's 397 crores. Thankfully, the company has 836 crores cash on books to tide over any unfavorable outcome. The next metric is contingent liabilities. A contingent liability is a possible obligation that may or may not occur depending on a future event. So low to nil contingent liabilities are desirable. The contingent liabilities are quite low at 1.7 crores. That's good. However, in December 2023, the company received a GST show cause notice for a tax liability of 327 crores. More details are awaited on the matter. Last but not the least, let's check the key risk factors mentioned in the company and its RHP. Now there are as many as 84 risk factors mentioned by the company, but many of them are like disclaimers and standard statements. Here we will take a look at some of the prominent ones. First, the company has incurred losses in each year since incorporation and has negative cash flows. Second, the company faces intense competition. This is a risk factor that we discussed in Zomato's case too in an earlier video. Third, the food business is subject to several regulations. The company can be held liable if its restaurants and merchant partners fail to ensure the hygiene, quality, quantity, and weight of food products. Fourth, the company is overly dependent on its delivery partners, merchant partners, and restaurant partners, and they may prioritize the services of its competitors. We identified this risk in Zomato's case too. Fifth, its material subsidiary Scootsie has been loss-making, and these losses have climbed from 295 crores to 424 crores between 2022 and 2024. Notably, A major part of fresh issue proceeds are meant for Scoot C. So, these were some of the risk factors. I would encourage you to go through the complete list in the company's RHP. Alright, let me now summarize the positives and negatives of Swiggy's IPO and conclude the video. Swiggy is a new age company and obviously it carries the risks and opportunities associated with the new age investing. If you are interested in analysis of new age stocks, you can watch a related video on this topic. The link is in the description. Now, Swiggy's positive include a high growth rate, a fast growing and promising industry, and a debt-free balance sheet. The company seems to be on the turnaround part 2 and has cut its losses. Even Zomato was loss-making at the time of its listing, but that didn't stop it from going up 66% on the listing day. The negatives include loss-making operations, high competition, and over-dependence on its restaurant, delivery, merchant, and brand partners. The offered price band appears high when seen from the perspective of acquisition price in the last 1 year. The company is not promoter driven and its founders are left with a little stake now. But that can be interpreted as both positive or negative. Positive because the company is professionally managed and negative because the ultimate accountability is diluted. Finally, as compared to Zomato, its main competitor, Swiggy is clearly behind. But Swiggy's valuations are much less and the race between the two is still on, right? And with this, we have tried to cover all you need to know about Swiggy to take a call on its IPO. Now it's your turn to tell us and your fellow viewers whether you will invest in Swiggy's IPO or no. Do let us know in the comment section along with the reason for your answer. And that's all I had for you today. I hope you found this video useful. And if you did, please don't forget to share it with your friends and family. I'll be back soon with another video. Till then, take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.